Imagine waking up to find that the fundamental rule of Bitcoin was about to be completely rewritten. Imagine a handful of developers altering the blockchain's history to recover billions in lost funds. It sounds like a dystopian nightmare. Concocted by a central bank. But on the 27th of February, this exact scenario was proposed for the world's largest cryptocurrency. It threatened to shatter the illusion of absolute immutability and split the entire network in two. Wow. My name is Lewis, and you're watching The Coin Bureau. So, is the digital gold thesis officially vulnerable to human intervention? Are we staring down the barrel of a chain-split doom loop? Or is Bitcoin's social consensus actually stronger than ever? That's exactly what we're going to cover today. First things first, though, let's look at the catalyst that just sent a shockwave through the Bitcoin governance model. On Friday, the 27th of February, 2026, former Mt. Gox CEO Mark Capellis published a highly controversial pull request on the Bitcoin Core GitHub. He proposed a hard fork to recover funds from one of the most infamous wallets in crypto history. The address is known as 1FEEX. According to on-chain data, this wallet holds exactly 79,957.22 BTC. These coins were stolen during a compromise of Mt. Gox's internal systems back in the 1st of March of 2011. They have been sitting completely dormant for 15 years. Because the private keys are either lost or held by the original attacker, these funds are effectively frozen in plain sight. But at today's prices, that trapped Bitcoin is worth approximately $5.29 billion. That is a massive pool of capital sitting completely out of reach of the Mt. Gox creditors. So, Capellis proposed a patch consisting of fewer than 50 lines of code. This code would implement a consensus rule change. Put simply, it would allow those specific coins to be spent using a new designated recovery signature overriding the original private key. It was a direct proposal to bypass the cryptographic rules of Bitcoin to correct a historic theft, and the market implications of this are absolutely terrifying. Now, to understand why this is so dangerous, you need to understand the doom loop that lives inside a contentious hard fork. If a proposal like this actually gains traction, it requires near unanimous agreement from miners, node operators, and exchanges. If parts of the ecosystem refuse to adopt the rule change, the network fractures and you get a split chain. One chain enforces the recovery rule, while the other preserves the original ledger. We saw exactly how destructive this can be during the Bitcoin Cash split in 2017 and the brutal hash wars of 2018. But the crypto market of 2026 is vastly more leveraged and interconnected than it was back then. If a split looks imminent, the first thing major exchanges do is freeze deposits and withdrawals to prevent replay attacks. When exchanges freeze, market makers pull their liquidity. Order books thin out by 80 to 90%. And this is when the derivatives market implodes. Just look at the flash crash that we saw on the 5th of February this year. Bitcoin briefly touched $60,000, triggering a massive $2.67 billion in liquidations in a single day. But that was just a macroeconomic shakeout. A contentious hard fork would trigger a liquidity vacuum that would make the February crash look like a minor dip. Leveraged longs would get liquidated, forced selling would hit a thin order book, and the price would nosedive. It is a self-reinforcing machine of absolute carnage. And speaking of staying ahead of contagion, this is exactly why you need the Coin Bureau Telegram channel in your life. That is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so that you don't miss a thing. Whether it's a controversial GitHub pull request or massive ETF outflows, our members see it first. So sign up today using the link down below or by scanning the QR code on the screen. Now, before you let this scenario send your stress levels to the moon, consider that the Bitcoin community did not let this proposal get very far. The pull request was automatically closed by GitHub within roughly 17 hours and locked as spam. Prominent Bitcoin Core contributors like Matt Corallo and Peter Woola quickly pointed out that GitHub wasn't even the appropriate forum for this. Capellis hadn't even submitted a formal Bitcoin improvement proposal, And we also have historical precedent that a network can survive a recovery fork. Cast your mind back to July of 2016 when the Ethereum network was hard forked to recover roughly $50 to $60 million stolen in the DAO attack. Ethereum survived, Ethereum Classic was born, and the sky didn't fall. So you could argue that the system worked perfectly here. The social consensus of Bitcoin rejected the change immediately, proving that the network is as immutable as we all hoped. But there is a harder question that the 17-hour shutdown is actually masking. Because the real threat isn't the code. The real threat is the precedent it sets for the $89.5 billion currently sitting in US spot Bitcoin ETFs. Since these ETFs launched in early 2024, the plumbing of Bitcoin has become deeply entangled with Wall Street. BlackRock's IBIT alone holds over $50.15 billion in Bitcoin, representing roughly 56% of the entire US spot ETF market. And if you dig into the legal prospectus for IBIT, you will find a rather worrying clause. It states that, in the event of a hard fork, the sponsor shall determine which network shall constitute the Bitcoin network. The sponsor is, of course, BlackRock. Fidelity and Bitwise have similar discretionary language in their filings. This means that in a contentious fork scenario, it isn't just the miners or the node operators who decide the winner anymore. It's Larry Fink. If BlackRock declares that the forked chain is the real Bitcoin, $50 billion in institutional capital instantly follows that decision. So, Wall Street has effectively become the kingmaker in any future governance dispute. And that fundamentally breaks the decentralized consensus model. Furthermore, if a hard fork is ever successfully executed to recover stolen funds, it completely destroys Bitcoin's legal shield. In November 2024, a U.S. appeals court ruled that the Tornado Cash smart contracts could not be sanctioned by OFAC because they were immutable. Because no one could alter the code, it couldn't be classified as controllable property. Immutability is literally the legal defense against government seizure. If the Bitcoin community proves that it can rewrite the ledger for Mt. Gox victims, regulators will immediately demand the exact same treatment for sanctioned addresses. The digital gold thesis relies entirely on the premise that no CEO, no developer, and no government can change the rules. If that illusion is shattered, well, the institutional capital will flee. And we are already seeing how skittish the capital can be, with US spot ETFs suffering roughly $6.39 billion in outflows over the last few months.
What's the verdict?
Well, let's be blunt. The immediate threat is over. The Carpelli's proposal was poorly executed, submitted to the wrong forum, and shut down in record time. Bitcoin's technical robustness remains completely intact, but the vulnerability this exposed is absolutely real. The fact that a one-time exception was seriously drafted for a $5.2 billion honeypot proves that the temptation to rewrite history, however apparently well-intended, will never truly go away. The legal architecture of the spot ETFs has quietly shifted an enormous amount of governance power into the hands of traditional finance, and the psychological damage of realizing how fragile social consensus can be is profound. Bitcoin is only as immutable as its community wants it to be. This time, the community held the line. But with $5.2 billion on the table, you could be certain this won't be the last time that this line is tested. But what do you think? Was the community right to aggressively shut down the Mt. Gox hard fork? Or should exceptions be made to recover billions in stolen funds? Let me know your thoughts in the comments down below. And if you want to understand how institutional ETF flows are impacting Bitcoin's base layer, well, you could check out our video on that right over here. And if you want to see how macroeconomic forces like tariffs are threatening the digital gold narrative, well, you could check out that video right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.